Hello traders, Gary Wagner here, just about 11 o'clock in Honolulu, 5 o'clock in New York on Monday, the 28th day of April, 2014, and this is the daily report for gold and silver. We absolutely have a little bit of profit taking going on this morning as we come off of a very, very strong upside move last week. When we look at the board, we do have gold trading under $1,300 per ounce, $1,295 and change. Puts it off roughly $6 to $7 on the day. The low is $91.70. The high is $13.0580. Silver also trading lower, off about 14 cents today. The key to me is whether or not we will see this market close under 1958. 1958 has been a pretty key Fibonacci level on silver. The low 1941, the high 1983. More on silver towards the end of the show. You know, traders, after the dramatic moves we witnessed on Thursday and Friday last week, in which we saw gold really break above 1,300, my hopes had been that we would hold above 1,300, but a round of profit taking is to be expected, and it's really not all that uncalled for. However, we want to realize at the same time that this marketplace is really being driven on a lot of safe haven and premium being added or taken away from the perception of what's going on in the Ukraine, the conflict between the Russian and the Ukraine governments right now. On top of that, we have a number of economic pieces of data coming out, most of which is GDP as well as FOMC meetings, which will begin tomorrow. On a technical basis, here's what we're looking at. In terms of the level of support that I would really like to see gold hold right now is going to be 1287. That's that 50% retracement mark right in here. We haven't really come close. Right now, I am pegging current resistance at about 1312. That's our 38% resistance area. We see one top here, but we have some real resistance just before that at this particular top, and this is off the high of the day, I believe 1305, as we just talked about. 1305, 1312 areas to the upside. Areas that I'd like to see it hold absolutely is 1287, and absolutely critical is the fact that we have maintained this marketplace above that 61% retracement. And of course, the 61% retracement we are referring to is the retracement of, we'll call it the January rally, but it's a rally that began at the beginning of the year, really taking gold about, $200 higher. And the fact that when it retraced, it stayed above that 61% retracement, well, you know, that was one of the key factors in us believing we had some real strong potential to the upside, and that we could, in fact, have been witnessing the end of that corrective action. So I bring our attention to our daily chart, and this daily chart we have been using, really, we've looked at a couple of candlestick patterns that we have identified. We talked about the fact that as this market came down, we really saw the makings or the development of a really nice candlestick pattern, Three River Morning Star. First requirement is it occurs after a downtrend. We got that. Long red candle, star, and then long green candle. We actually got confirmation. That, of course, was on Friday. Today, though, what we're getting is really almost either an incomplete dark cloud cover. It could even be complete because you have to open at, and it opened right about and then close at or below the midpoint. When we compare body size, we probably ran into that. We are going into the way they're charting the next day. You can see this candle forming right here. And as I said, it's still under pressure, trading at around 1295.20. However, let's go ahead and remove this box here, and let's look at this market in another way. And the other way that I'm talking about is as a Japanese average. Now realize the big difference between a Japanese average chart and a candlestick chart is a candlestick chart has true opens and closes, whereas what we see in a Japanese average chart is it compares itself to the prior day or the midpoint. So when we look at the candle that has been formed, you'll see even though it was a down day, we're getting a green candle. You've got this doji, very, very nice turning point. That was really significant in that this is where that long green candle came in when we looked at it through a regular Japanese candlestick chart. So although it's early to tell, we're still green. Body size absolutely smaller. However, we do not have any wicks on the bottom, and that's a good sign. All that really means is it never traded at any point during the day below the midpoint. So I still believe that what we saw is an A, a B. I believe we've completed our C, and I'm hoping that we have now entered in impulse phase. We will have to see. We talked about what we really need to have solid technical evidence that we've broken back into an impulse phase. Two basic things have to happen. The first thing is we have to break above these most recent highs at around 32. I believe 32.50 was the high right there. We need to break above that. There's no doubt about that. That's the first thing. The second thing is really a technical study that we've been doing off of our Andrews Pitchfork. Let's go ahead and pull that chart up. And of course, this is the chart that I'm referring to. And the critical area that we're really looking at right now more than anything else is this zero prong right here. This is the outer prong here. This is the 100, of course, here. And then our handle in the center. For those who are recent members, this basic pitchfork is drawn from 3 data points. One, the very, very top of the market. I haven't compressed it enough to see that. And then this low here, which occurs at around 1535, I believe, and this high here at about 1800. So when you take these 3 data points, you create the Andrews Pitchfork, and what you actually get is this cascading channel line that really gives us an indication of whether or not we're still in a bear market, because even during times when the market is moving up, the fact that it was still trading within these channel lines, these cascading channel lines, didn't give us any evidence that we were out of any kind of a bear market. In fact, the only indication we got was this last stab up. This, of course, is our January rally. And for the first time since we put this chart up in 3 years, we saw it actually exceed and break above that channel line ever so slightly for ever so short of a period of time, but nonetheless, it did break above it. Then it moved back in. So the question is, we need to, in terms of our support area on this chart, what we're looking at is it needs to stay above the 23% marker. And so what we'd like to see is this market eventually break above this point, and this would be that final piece of technical evidence, because a solid break and continuation above that really would show us for the first time in years that we were out of the muck, out of the mire, out of this bearish tone that has been prevalent within the market itself. So all things being equal, when we step back, this is a 2-day chart with our current Elliott wave count. There's really 2 models that I was really looking at over the weekend. And actually, let me go ahead and blow this chart up so you can have a sense for what I'm talking about. And that is, we took a stab at the market, and our belief, of course, has been under the pretext that what we saw was a conclusion to that C wave. So we have wave 1, then we have our A, our B, and our C. We believe that we concluded that. We did have a lower low on there. However, another possibility, another potential model, let me change the color on this so that it's a little bit easier to see. And the only other thing that could be occurring, let's go ahead and start this count over, so to speak, but the only other thing that could be occurring is we have our A, we have our B, and our C could be here, could be a 3 count, up a little bit, and then one more swing down. However, I'm not looking at that right now as the most plausible of the models, but anytime we see the market kind of correct, I look at any possibility, and it's my job as an analyst to present all possibilities to you. But my sense for the time being is that we have probably concluded 2 and are now beginning an impulse wave, wave number 3. So as far as silver goes, traders, you know that I have not been extremely bullish. I haven't really been bullish at all in silver because we have really seen gold rally, and as gold rallied, we really saw, most importantly, No follow through in silver. Now, we're looking at a daily chart. Let's go ahead and compress this just a little bit. But my sense is that we had really only one true breakout. And when we consider that the gold market from, say, the beginning of January for a couple of months straight really made a solid but steady incline up at a nice angle, at a nice tack, we saw silver trade sideways and then spike, and then after that spike really do nothing but come in, initially find a little bit of support at 1958. You can see that it traded at and above that for quite some time, but now it's really fallen through that point. And as I said, the key to me is whether or not this market is above or below 1958, because to me that's a critical Fibonacci retracement level. The little retracement in gold trading at 1296, I'm not all that concerned. A little round of profit taking can be healthy. At the same time, I still believe we should be sidelined on silver and long our gold position. Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.